Okay, for 21-2, it is pretty much identical to yesterday's, only this time we are dealing with notes payable instead of notes receivable. So how you calculate things are exactly the same. This time we're dealing with payables instead of receivables. So it should be fairly easy. So first we're going to plan our adjustment. So interest payable is going to be a credit of $20. So remember to calculate that. We're going to take 2,000 times 12% times how many every days. So from December 1st to December 31st, so times 30 days divided by 360. So that's how I got that $20. So then it's an interest expense debit for adjustment. Okay. And then our next instruction, journalize and post the adjusting entry for accrued interest on December 31st. Use page 14 of the general journal. So our journal in here. So remember we're going to label that first. So this is adjusting entries. The date is December 31st. And I just transferring the information down. So we'll do our debit first. So interest expense. Post reference not yet. It's a debit of $20. And then interest payable, credit of $20. And then journalize and post the January 1st reversing. No, did we do closing? Sorry, 3. Journalize and post the closing entry for interest expense on page 14. Okay, so we're going to label that closing. Our date is 31st again. And so income summary will be our debit account. $8,497. Our next one, our credit is interest expense. Credit of $8,497. Okay. Next, journalize and post the January 1st reversing entry for our accrued interest expense on page 15 of the general journal. Okay, so account title is reversing. Date is January 1. And then remember that's going to be just the opposite of our adjusting. So interest payable, debit of $20. And interest expense, credit of $20. And then we're going to journalize the payment of the cash for the maturity value of the note on March 1st. So cash payments. Our date is March 1st. The account title is notes payable. Check number 543. It is a general debit of $2,000. And our second line is interest expense, a debit of $60. Remember to get this, you have to calculate the full amount. So 2,000 times 12 times 90 over 360. And so we add this together and get $2,060. Add an extra 0 back there. Okay, so we have all of our journalizing done, so now we're going to go and do our posting. So I'm going to go back to my journal, page 14. And so the first thing we do is interest expense. So the date's the 31st. Post reference is G14. G14. It's a debit of $20. And so my new balance then is $8,497. Post reference is 8105. Next we need interest payable. So December 31st. This reference is G14. Credit of $20. Credit balance of $20. Post reference 2110. Okay, next we have income summary. December 31st for our date. Post reference is G14. Debit of $8,497. Debit balance of $8,497. And post reference 3120. Okay, and then we have interest expense again. So our date's the 31st. G14. A credit of $8,497, which means our debit balance would now be 0. Our post reference is 8105. Okay, now we're going to go to journal page 15. And we need interest payable. So our date is January 1st. Post reference is G15. It is a debit of $20. So our new balance would be 0. Post reference is 2110. Then we have interest expense. Date is January 1st. Post reference is G15. And it's a credit of $20. And so then we'll have a credit balance here of $20. Our post reference is 8105. And then finally we have our cash payments journal. So notes payables first. So date is March 1st. CP 25. A debit of $2,000. So our credit balance is 0. Post reference is 2105. And then interest expense. So March 1st, CP 25. It's a debit of $60. And so, if you remember, expense, our normal balance is actually on, should be a debit. So we're going to have basically like a negative 20 plus 60. So our new debit balance is $40. Okay, so we have that done. You can go ahead and do the 21-2 on your own.